Hey guys, it's Rudi coming at you live from Palm Beach in Florida. It is Saturday evening. It is September the 14th, and I have a couple of housekeeping items that I want to attend to and bring to your attention and share with you. So first, what I want to do is just go onto the YouTube channel for a minute. So I want to show you this. The user here asked a question. Hey, Rudi, could you give us your current thoughts on the recent dip in oil prices? I'm going to do that for you in just a minute. And we'll talk about that just a little, because really what we talk about when we talk about oil prices is we're talking about futures. But what I wanted to do is also share with you this comment here, which is in Portuguese. So obviously I don't speak Portuguese, so I had to go to Google Translate to see what Leonardo has basically shared with us here in relation to an old video. And my question was, can Equinor ASA replace Petrobras? At that point in time, my thesis was mainly related to dividends, and Leonardo summed up something for us there, which I'm going to share with you in just a second. Let me just find it quickly and see if I can show you that one. So just bear with me for just a minute so that I can get in there and show you what's going on here. So basically, Leonardo wrote in Portuguese, and the translation from Google Translate is Brazilian greetings. Anyone who is afraid of this or that government, in my humble opinion, should not invest in state-owned companies. My mindset is we should invest in spite of governments. Well, that's actually not a bad idea, especially when it's a democratically elected government, because governments tend to come and go, whilst the companies that we are invested in stay for a much longer period than that. Then he adds, thank you very much for the video. We have a few Equinor articles here, so good videos are always welcome. He says, for us Brazilians, I don't know others for others too, dividends already come at a 30% discount. So I prefer companies that pay little or no dividends, as I am in the equity accumulation phase. That's an important point that he's making here, because he's basically saying, I prefer companies that pay little or no dividends, as I am in the equity accumulation phase. Many of us are not. Some of the people watching this video are actually fixed income investors relying on dividends. And quite simply, if a company pays a high dividend, so I talk about Energy Transfer a lot, and that one pays a dividend of around 8%. If it's paying a dividend of about 8%, for every $100,000 you put in, you earn $8,000 worth of income on an annual basis, regardless of what the stock price does. So there's a different investment narrative. So this is true for Leonardo, but it's not necessarily true for everyone watching this channel. If this is basically why Equinor is falling, I will increase my contributions. Of course, you could always say it's a good idea to, using the Warren Buffett philosophy, buy when everyone else is selling and sell when everyone else is buying. Let's take a quick look here at oil. And I want to address that sort of question from the visitor who commented on the website, and unfortunately has a YouTube name that I cannot pronounce or say, because it looks like a strong Google password as opposed to a username. So we're going to talk a little bit about oil from a macro perspective. I'm going to talk a little bit about trading futures, and let's call it a moment of Zen on oil with Rudi Bester. So here's the first thing, right? So every day we are bombarded by messengers who provide us with a whole variety of messengers, and usually all news is bad news when it comes to the media, right? So if you look with me down here at the bottom on the right-hand side, a week ago, well, OPEC discusses delaying supply boost after oil price crash. 6 days ago, oil gas drillers ease up as prices crash. 3 days ago, oil prices dropped 4.5% on record bearish sentiment from money managers. 3 days ago, oil prices fall 3% without a real change in fundamentals. And the reason why I kept that one till last is because it's a very critical point, right? There was no specific change in fundamentals. And when we talk about fundamentals, even as it relates to futures, we're talking about supply and demand, the basic thesis underlying any commodity, especially a commodity like energy in general. So not just oil, but energy in general, which we consume and use every single day. Even while you're watching this video right now, you are consuming energy. And after this, you might charge your mobile device, and you might get into your car or on a bus or on a train or on a plane. We are consuming energy all the time. More news, which is bad news. CNBC reported just the other day that crude oil futures on Tuesday, so that was at the beginning of the week last week, closed at the lowest level since December, and the market sell-off gained speed after OPEC lowered its demand for the second time in 2 months. Crude oil demand destruction is a 1-2 punch from China with its slowing economy, and OPEC, who delivered the knockout blow today, said Bob Yeager, the executive director of energy futures at Mizuho Securities. He said that to clients in an afternoon note. Incredibly, the market is getting beat down while a tropical storm hurricane churns up the U.S. Gulf of Mexico oil patch. Well, as many as 300 rigs are currently down because of that tropical storm. But, you know, bad news is bad news, and that's what the media does, right? Now, let's take a look at this. When we look at crude, well, I just mentioned in the previous slide that we're talking about crude oil futures, right? So this is the continuous contract. Now, in a way, you could say, well, in the same way they can't really tell us with absolute confidence what the weather is going to be like next month, they certainly are quite confident telling us what oil should be trading at in a month from now, because when you look at oil today, you are actually looking at October's futures. Now, right now, we're in the middle of September. In other words, we are sort of predicting the price of oil mid-October at around $67.90. And then when we get to mid-October, the futures will be giving you the price for November, and so on and so on. When we look at the futures over the past 5 years, which is the period that I highlighted here under my red arrow, you will see these incredible peaks and valleys, right? So peaks are great because the price is high and everybody's making a lot of money, including people trading energy stocks or investing in energy stocks, the latter of which is what I do. I don't really trade the stocks. But at the same time, if you look at 2020 here, remember the pandemic? It seems so yesterday, right? Well, it's kind of more like last week. Maybe it's more like 4 years ago. The oil futures took an enormous tumble. And in fact, at one stage, for just a short little while, it was even trading negative. What a wonderful time that would have been to buy. And if you had been with me over the last 4 years, you might have bought Occidental Petroleum at that point in time for about $8, $9, or even $10 per share. So right now we are kind of down. But if you think of the graph and sort of ignore the two red circles, the line sort of runs sort of, if I had to draw a horizontal line, maybe at around 75, 80, if it were a straight line. And of course, it never is. But that's how the futures work. And right now we are trading low because we are in the 60s. And just a short while ago, we were actually at 130. So we sort of 65, half of where we were just a couple of years ago. So what exactly are oil futures? Now, this is kind of just for your information if you're not familiar with it. But a futures contract is basically a price of settlement date, oil quantity, oil quality, and the settlement method. Collectively, these could be called derivatives because effectively what you're doing is you are creating a futures contract with a derived value at a future date. That's why it's called a derivative. The derived future date in this particular instance is about a month from now, as I mentioned at the start. At the bottom here, how do oil futures work? So oil futures are financial contracts in which a buyer and a seller agree to trade a specific number of barrels of oil at a fixed price set for a future date. But very importantly, just below that highlighted section, it says crude oil futures give the buyer the obligation to buy at the underlying market, and the seller the obligation to sell at or before the contract's expiration date. Now, if the price of oil is going up, the seller may want to sell it as quickly as possible in order not to pay a higher price. And at the end of the day, that's just how trading works. And traders got to trade, and that's what they do. And that's one of the reasons why you see these wild fluctuations and swings in the oil price futures from time to time without any change in fundamentals. We're going to talk about supply and demand in just a minute, so bear with me here. So the oil futures contract, settlement date, and then the future trade happens at a certain date in the future, which is about a month out from where we are today, using my September 17th example, or September, what is the date, 14th example. So 1,000 barrels at a certain price sets the futures contract. 1,000 barrels, that's according to IG.com. Who can trade futures? Well, pretty much anyone can. In fact, if you go to your brokerage account, you might be able to find a tab that says oil futures or futures in general, because you can trade many, many, many futures, different things. These are all called real assets. Some people trade in livestock futures. Some people trade soybean and rice and things like that, right? So you can trade in all kinds of futures contracts if that's what you want to do. However, if you don't know what you're doing, then you probably shouldn't be doing it at all, or at least take some time, set aside some time, and learn how it works before you start doing crazy, crazy things. As I mentioned on the previous slide, 1,000 barrels is the minimum tick size and value. 1 penny equals $10 in terms of the contract value. The settlement is physical, right? So you actually are delivering physical barrels of oil. Well, not you personally, but that's actually how the trade is settled. Investors can use crude oil futures to hedge against investments in their portfolio, right? So if you think oil is going to keep going down, you can actually start looking at potentially investing in futures and using that as a hedge in your portfolio in order to protect yourself on the downside. Now, to be fair, if you are going to be invested for a longer period of time, which by now probably you would know if you've been watching my videos, my typical time frame is at least 3 to 5 years. I'm not too worried about these crazy market fluctuations, because at the end of the day, like I showed you on the oil futures chart for 5 years, you can kind of draw a horizontal line and you're at about $75, $80. And the break even for most of the drillers, for instance, in the Permian Basin, is around 40, maybe 40 something, right? So when you have a price that's sort of $75, $80, that's a very decent price for the drillers, because with a cost basis or break even of around 40 something and a price of, sort of 70, $80, you're almost doubling your money on every barrel of oil. Down here at the bottom, crude oil prices can change due to a number of factors, but primarily from the perceived changes in supply and demand. Those are the fundamentals, the primary fundamentals, supply and demand, that comes from both overall output worldwide and the economic health of the industry's major consuming countries. We're going to talk about that too. Now, I told you what happened at the beginning of the week, and I showed you all the bad news from Monday and Tuesday of last week. Now, Friday, so just a day ago, Trading Economics reported that WTI crude futures rose to around $69.40 per barrel. Now, earlier in the week, on Tuesday, it actually touched around $64, $65, and by Friday, it was back up to $69. This doesn't mean that it's going back to $80, $90, or $100. This just means that the quick drop of almost 3% had pretty much been wiped out, if I could put it that way, by Friday, so just a few days later. And the reason for that, now, the news says, advancing for the third consecutive session, supported by supply concerns stemming from the impact of Hurricane Francine in the U.S. Gulf of Mexico. On Thursday, the hurricane shut down 730,000 barrels per day. So 730,000 barrels per day is quite a lot. I mean, it's close to a million, so 750,000 barrels per day, or 42% of the crude production in the region. Despite this, a downside bias for oil persists due to worries about sluggish demand in major markets. We're going to talk about that too. Remember a minute ago, I said you can trade all kinds of futures. So here's an example of the futures that you could possibly trade. Crude oil at the top, and then down here at the bottom, other precious metals, gold, silver, copper, soybeans, wheat, coal, steel, etc. You can trade futures on a whole variety of different things. But before you do anything like that, first make sure you know what you are doing. Now, where exactly are these global commodity trading hubs? There are 3 of them that are sort of quite obvious in terms of their geographic location: the US Gulf Coast, UAE, and Singapore. And then you have this quirky one at the top here, ARA. Petroleum products and petrochemicals are traded there in that commodity hub. ARA is not some fancy secret term. It actually is literally just an abbreviation for Amsterdam, Rotterdam, and Antwerp, in my best Dutch accent, right? Amsterdam, Rotterdam, and Antwerp. Those ARA commodities are traded in that particular trading hub. So that's where the trades happen. I want to take you here. This is on LinkedIn. And by the way, right at the bottom, I added a little snapshot picture to my LinkedIn. If you want to follow me or connect on LinkedIn, you're welcome to do that. So Vresidas Nioftio, I hope I said that sort of correct, posted a post on LinkedIn, and he said the sell-off started when OPEC Plus said in a monthly report world oil demand would rise by 2 million barrels per day in 2024, down from last month's forecast growth of 2.11 million barrels per day. Now, to be fair, 2 million barrels per day is 2 million barrels per day. And when you have a delta in this particular instance here of 0.8 million barrels per day, or 80,000, that's not really a lot, right? So it would be quite bold to make a statement saying the sell-off started because OPEC revised their forecast for growth from 2.11 down to 2.03. He adds OPEC also cut its 2025 global demand growth estimate to 1.74 million barrels per day from 1.78 million barrels per day. Again, this is not significant, except you could argue that it's trending down or negative, right? Due to fears about slowing global demand, I have no idea really how they forecast that, because it's easy to say, it's very difficult to prove, and I like facts. I don't really like emotion. And then my friend on LinkedIn, and you can follow Dr. Salome as well. He always has very good information that he posts. He said, when OPEC Plus makes a projection about global oil demand growth in both 2024 and 2025, it takes into account economic and geopolitical factors in the market and even US market manipulation. We have a lot of that right at the start. I say traders got to trade. And the impact of Western disinformation, media lies on demand and prices. We see this all the time, right? Sometimes we see on Tuesday of any week, there's a supply crunch, and a day or two later, there's a demand crunch. They just make this stuff up as they go along. You cannot rely on what you read in the media. Most of it is fake news. Sometimes all of it is fake news. And Mark Twain once summed it up really nicely when he said, if you do not read the newspaper, you are misinformed. And you are not informed. And if you do, you are misinformed. I probably screwed that up too, that quote. That is why projections are relatively most accurate from OPEC Plus, and they tell us that global oil demand will still grow by 2.03 million barrels per day in 2024 and 1.74 million barrels per day in 2025, said Dr. Salome. Now, here's an actual chart, ironically published by the EIA. The blue line here showing you OPEC's current production. And you can see sort of in the area over here where I'm circling where we currently are, because this is 2024. And then, of course, 2025, you see a slight uptick in the production with small little peaks and valleys, but basically sort of flatlining at around, to sort of call it 37, 38 million barrels per day. It's expected to be more sort of 40-ish, but let's go with 37. How about oil production in the United States? And here I'm looking at a period that's quite extensive because it's 25 years, right? Over the last 25 years, you can see it's only gone one way, and that is up. So the United States is producing more and more and more all the time. There are a couple of small anomalies here. And ironically, they are small anomalies, even though there was a huge market crash. For those of you who are old enough to remember, think back of the dot-com boom and bust, sort of around 2000 here on the far left. And then in the middle of the screen the financial crisis of 2007, 8, 9, etc. But still, oil production increased gradually, took a little dip in 2016 and took a little dip again. That's amazing, right? Look at this small little dip that oil production took in the United States in 2020 during the pandemic. In the height of the pandemic, it only dropped a little and immediately flatlined the following year before it ticked up again and again and again. I added this long red arrow here in the middle of the screen just to show you that the general trajectory on this particular graph is just up. It's positive. Oilprice.com says this is US oil price production, and the legend down at the bottom of the screen tells you that it's by year. And I circled two things here. Firstly, there is that red dip, which was 2020, which was the pandemic. And then the yellowy line, mustardy colored line, whatever the color that is for you on your screen. At the top here is the forecast. And you can even see that the forecast for 24, the remainder of 2024, even that is edging slightly higher, not lower, right? So if there's really some kind of a drop in demand, then you should expect some of the lines on the right-hand side of the vertical line in the middle to be dipping down rather than dipping up. Although there are certain times of the year, towards the end of the year, November, December, when there is a slight decline in production, usually. So how about the demand, right? So we talked about the fundamentals and we talked about supply and demand. So this is demand, the world's liquid demand outlook. And my source here is the EIA, World Energy Outlook, which was published in 2020. In 2019, which is obviously now easy because we're looking in the rearview mirror, so it's easy to judge. We're looking at the trajectory from 2019 to 2030, and you can see there's an uptick there. And over the next decade or so after 2030, you see it goes up again. So once again, I added the red arrow there because you can see the trajectory of the graph is upwards and positive. The other thing that's interesting here is that currently we are consuming just over 100 million barrels per day. Now, whether the news media tells you that demand is rising or supply is in an oversupply situation and the prices have gone up or the prices have gone down because of demand or supply or whatever the case might be, at the end of the day, this matters absolutely nothing because we are consuming 100 and a bit, call it 102 million barrels of oil per day. And every single day that passes, we consume just a little bit more. Now, arguably, price is not necessarily directly related to demand, but when you have a commodity like oil with an increasing demand over a long period of time, if you ignore the dips and valleys that happen all the time, you'll be okay. If you're day trading, that's a different issue altogether. How about the producers in terms of consumers and comparing that to the producers? So the interesting thing here is that the United States, close to about 20 million barrels per day, is the largest consumer of oil in the world. The next two countries, China and India combined, are at about 21 million barrels of oil per day. So China and India combined is almost the same in terms of consumption as the United States. The difference, though, is that even though the United States oil consumption is growing, these two economies especially are growing much, much faster. And in addition to that, if you include the third country here, Japan, which is not even a producer, and you add these three of the top, let's call it the top five, excluding the United States and Russia. But if you add China, India, and Japan together, you're almost at 25 million barrels per day that these three countries consume. And of them, only China actually produces a little bit, relatively speaking, right? So the top oil producing countries in the world, once again, the United States producing approximately as much as what it consumes. And then the other countries that are on here are actually in a fairly good position because Saudi Arabia and to a lesser degree, Russia, because Russia is not only a large producer, but they're also a large consumer, and Canada. So Saudi Arabia and Canada, Iraq, Iran, Brazil, etc., in a pretty good situation because economically speaking, it adds to their GDP because they produce significantly more than what they consume. And that's a nice position to be in because then you can export the rest and just bank the money. How about global oil demand? And we see it outpacing global production. So right here on this graph, and it's a little bit obscured here under my pretty picture in the far right-hand corner, but you can see the lines. If you look at the yellowy sort of orangey line, consumption, and the blue line is production. The production line and the consumption line are sort of level pegging, right? So we don't really have a problem here. And this is sort of looking forward, Q3, Q4, 2024. And where we are right now, we've just gone through Q2 of 2024, and you can see consumption was just below production for a short period of time before it bounced back up again in Q3 where we are right now. How about historical petroleum consumption and the EIA forecast? And here I have a term that is almost 30 years, right? So from 1990 to 2028. The IEA consumption and forecast, this blue line shows you in terms of where we are today. This is sort of where we are right now, and there's their forecast on a go-forward basis. This is not going down, it's going up. And this huge V in the middle of the screen here, where I'm circling my mouse, that was 2020 when we took an unexpected dip because of the pandemic. And the one in the middle here was 2008, 2009, and the financial crisis. So in order for a catastrophic price change to happen, there has to, unfortunately, be a catastrophic economical reason for that to happen. So the financial crisis, the global pandemic, wars that break out between different countries and all that kind of stuff. play a macro role in this particular instance. But all things being equal, with all the wars that are going on in the world right now, consumption is still predicted to be increasing year over year into 2030. A couple of headlines to close it off with. Morgan Stanley slashes its oil price forecast again. Just 2 weeks after lowering its Brent oil price, Morgan Stanley cut the price again. And the international benchmark on Brent, they're averaging around $75 per barrel in the last quarter of this year, says Svetlana Paraskova on oilprice.com. And then that was on September the 9th. And just September 13th, a couple of days ago, Michael Curran says oil prices lifted by ongoing surplus disruptions. So oil prices recovered, right? So you can see where I'm going with these news headlines because they keep bouncing around, right? So, I don't have a conclusive narrative for you here other than to say that if you're relying on the media, things are always going to be bad. It's not in the media's interest to tell you that things are good because clickbait is built on bad news. So they want you to read bad news stories all the time because otherwise you won't read their media, right? So it's one of those situations where you could say to yourself, just as an analogy, if there's a car accident on the highway close to where you live, you'll hear about it on the radio or the TV or whatever the case might be, wherever you source your news. But they're never going to tell you that 100,000 cars went by on that same highway uneventfully every hour for the whole day, right? That's not news. All things being equal, everybody's safe, everybody's fine. That's not news. One accident, yeah, that's news, right? So be careful where you get your news because at the end of the day, barring a major economic catastrophe or something that's gone horribly, horribly wrong, the traders are going to trade. If you buy a good company with good, solid fundamentals, including a strong balance sheet, not too much debt, good free cash flow, maybe a decent dividend, depending on where you're at in terms of your career and your wealth management and your requirements and cash flow and all that kind of stuff. Make sure you buy a good company at the lowest price that you can get it at, and then just hold it. And if you can hold it for a longer period of time, at least 3 years or more, as a general rule, you'll be okay. There are exceptions, right? So in the same way, right at the start of the video, I mentioned you could have bought Occidental Petroleum back in 2020, 2021, for maybe in the teens or even single digits, $9, $10, $11 a share or whatever. Now it's trading, even though it's trading low at like, 50, $60 or whatever the case might be, you're still up 5, 6x, right? Conversely, I've made videos before on Devon, right? So many people on our channel and in our investment community bought Devon when it was trading in the $70 range. Right now it's down to like $39, $40, right? So it's lost like half of its value. They're not the same companies though, right? It's not the same fundamentals. The other thing that's important there is that if the company is very reliant on natural gas, right now we are in a situation where the retail price, the wholesale price of natural gas is actually less expensive than the cost of production, right? So that hurts companies that rely a lot on natural gas. But you can diversify your energy portfolio across those natural gas producers and the companies like the pipeline companies that do the refining and move the oils and gases through their pipeline systems or whatever. Their revenue is fairly predictable because it's contracted revenue. And then, of course, there's the drillers. And when the price is low, the stock prices are low. Sometimes these create buying opportunities. Otherwise, the best thing that you can do is just hold and wait. So on that note, this is Rudi saying thanks for watching. Take care. And I'll talk to you soon. Bye-bye.